This is how several retail traders start their mornings. They wake up in anticipation as the market opens, their screens come to life. For hours, they remain glued to their stock trading portals, hunting for the next big opportunity. And once they find it, they place their bets. If the stock price climbs, the bet has paid off and the market keeps them hooked. Once they see a profit, they keep coming back to their trading apps over and over again. This is called stock trading, but increasingly it's borderline gambling. For a lot of retail investors, the lines are blurred and they're hooked on to a new trend these days, thanks to the latest wave of IPOs. Before we discuss it, let's get a basic question out of the way. What is an IPO? It stands for Initial Public Offering, IPO. When a company lists on a stock exchange, when a company enters the market for the first time, it offers its shares to the public, and the first such offering of shares is called an IPO, Initial Public Offering. And retail investors find it very appealing. They see an IPO as the next big money-making opportunity. We have a recent example. This week, Bajaj Housing Finance made its debut. This is a financial services company. It gives out loans to buy properties. Bajaj had a bumper listing in India. Its IPO was oversubscribed by 64 times. Now, what does that mean? What is an oversubscription? It means that there were far more buyers than the shares on offer. If Bajaj was offering 100 shares, there were 6,400 buyers. In other words, for every share that Bajaj had to sell, there were 64 buyers. The total bids were worth a whopping $39 billion. Obviously, Bajaj could not take all this money. It did not have shares worth $39 billion to offer. It wanted to raise just about $782 million. So the IPO was oversubscribed. Now, when this happens, the available shares are divided proportionally among all investors. So all those who applied to buy Bajaj shares will end up getting some shares, but far less than what they wanted. For example, if you wanted 10 shares, you might end up with just 2 or 3. It would depend on demand and supply. The more an IPO is oversubscribed, the fewer shares you'll get. And that's what happened with Bajaj. They went public yesterday with a bang. Overnight, the company's value has more than doubled. Before the listing, Bajaj was worth $7 billion. After the listing, the company's value has jumped to $16 billion. And that also means massive gains for investors. During the IPO, one share of Bajaj was priced at around 70 rupees. Today, it was trading at around 180 rupees. So what you bought for 70 rupees yesterday, you can sell for 180 rupees today. Look at the spike in value. Bajaj is India's 4th biggest major listing now, and this has been the trend this year. 2024 has been a big year for IPOs in India. More than 200 companies have gone public in the last 8 months. They've raised over $8 billion by selling their shares to investors. And this IPO frenzy is far from over. There are more listings in the pipeline, including some high-profile names like delivery aggregator Swiggy, electronics giant LG, and car maker Hyundai. The Indian units of LG and Hyundai are going public. As of now, they're privately held. When they go public, they raise money from the stock market. And how much money are they looking at? Each IPO could be worth over $1 billion. Global investors are tracking all of this. Last year, India became the world's 2nd largest IPO market, right behind mainland China. Meaning India is an attractive investment destination for the world. As more companies enter the field, India's stock markets are also expanding in size. They're challenging their global peers. It's a good trend, a trend worth building on. But here's the other side of the story. It features the retail investors, the ones I spoke about in the beginning. Their appetite for risky bets is growing. They see the stock market boom as an opportunity to make quick money. And some are even risking their savings and suffering losses because of it. India's market regulator recently conducted a study. That's SEBI, the Securities and Exchange Board of India. It's the market regulator. They held a study, and the findings are quite revealing. Most retail investors sell their IPO shares quickly. 54% of the investors sell their shares within a week. 70% sell them within a year. So they're not buying into these IPOs for the long term, and this kind of trading has seen a surge. We have some more data. About a third of individual investors trade on an intraday basis, meaning if they buy a stock, they sell it on the same day before the market closes. That's intraday trading. 6 years back, just 1.5 million traders in India did this. 1.5 million traders did intraday trading. Last year, the number of intraday traders shot up to a whopping 6.9 million. Now, most of these traders are young. 48% of them are below 30 years of age, and most of them are losing money. Last year, 7 out of 10 traders lost money in intraday trading. That's 70% of them losing money. What do these numbers tell you? This is not trading, it's gambling. And the government of India agrees with this assessment. It says, and I'm quoting, "A gambling instinct has gripped retail investors." The regulators are trying to build more guardrails to protect the retail investor in India, but clearly a lot more needs to be done. The thing is, Indian markets are growing and retail investors are maturing, which is all good. But stocks are instruments to build long-term wealth. It is not a shortcut to instant riches, especially if you don't know what you're doing. And this kind of trading also poses a threat to market stability. A surge in such trades could steer the market away from generating wealth for its investors and turn it into a casino. This is a long-term risk, and it cannot be ignored.